Hello, my friends. Today is April 12th, and this is Markets Weekly. So, this past week was a tremendously volatile and historic week, and it really feels like we're living in an era where decades are happening in weeks. So, it's an exciting time to be alive and be in the market. So, today let's talk about three things. First, let's talk about Trump's pivot on trade policy, where he suspended reciprocal tariffs on all nations but China. Secondly, let's talk about some of the good inflation data we got the past week that didn't seem to help the bond market. And lastly, let's talk about some really strange price action we're seeing in the market that could suggest that we are potentially in the process of a big regime change. Okay, starting with tariff policy. So earlier in the week, we got tremendous volatility in markets. Sunday futures opened down, say, 4 or 5%, although it did mostly recover. But more importantly, on the trade front, US China trade relations seem to be careening towards disorder. So China had imposed retaliatory tariffs on the US then re retaliated, and it was going back and forth. So really, it was just a huge escalation. Suddenly, though, on Wednesday afternoon, Trump posted on Truth Social that he would be suspending reciprocal tariffs for 90 days on all countries but China, putting out that China retaliated, which the US told everyone not to do. So, because of that, they're going to actually add even more tariffs on China. As of this recording, it's 125% tariffs, and China also has huge tariffs on the US as well. It seems like the two countries are at a standoff. But for everyone else, they'll just be paying 10% tariffs and plus the other sector specific tariffs that were announced earlier. So it's kind of a large pivot on tariff policy. Now, this surprised me, and many people in the Trump team have been saying that, uniformly, basically, that we're going to be tough, we're going to be tough. But then Trump did pivot on Wednesday. Now, the markets took one look at that pivot and absolutely surged. The S&P 500 was up almost 10% that day. So basically trading like a penny stock. Trump basically totally nuked all the bears. And I think anyone who wants to be short going forward is going to have to be very, very careful because who knows, the next tweet could totally nuke them. Now, reporting behind the pivot seems to suggest that Trump changed his mind for a few reasons, but first, let's hear from him.
Why you decided to put a 90-day pause?
Well, I thought that people were jumping a little bit out of line. They were getting yippy, They were getting a little bit yippy, a little bit afraid, unlike these champions.
So Trump is basically saying that, he got the sense that people were afraid about what was happening. I'm sure that he got totally deluged by calls from the business community, everyone trying to lobby him not to do this. Now, he also mentioned that, he was looking at the market, and the bond market in particular seemed to be concerning, and we'll talk about that later. And of course, reporting suggests that he saw Jamie Dimon go have an interview and give some remarks, and that seemed to shape his decision as well. Trump has tremendous respect for Dimon, who is a business leader and a very well-respected person in the financial world. So he's the CEO of JP Morgan. So all of this led Trump to change his tact a little bit. Now, it also suggests that within Trump's court, Secretary Bessent is gaining more prominence. Secretary Bessent was previously a hedge fund manager and viewed as a more moderate voice on trade, whereas people, let's say, like Peter Navarro, were viewed as much more hawkish. However, analysis done by Bloomberg suggests that even after the suspension of reciprocal trade, tariffs the U.S. imposes on other countries are much higher now than before. And on average, this separate analysis done from the Yale Budget Lab suggests that the average tariff rate really is still significantly higher. So even though the market's like this, even though this was a pivot, it really is a very big change on U.S. trade policy. Now, this weekend, the Trump administration did announce some exemptions on certain imports from China, including laptops and cell phones, basically the stuff that you can only get from China. Now, this makes sense from a policy perspective because for things that you can only get from China, the consumer is going to bear the brunt of those tariffs. And so it's going to make it a little bit more popular for them to continue the trade war. But for things like tea, for example, someone who is importing Chinese tea could, after the tariffs, could still get tea from other countries like Japan. So the consumer doesn't bear as big a burden. So that seems to be the policy where we are right now. Now, everyone is waiting to see who will blink, whether it's President Xi or President Trump. But these are two very proud nations and proud people, so it's not super clear on what's happening. Now, what seems to be the strategy at the moment is that the U.S. is trying to build a coalition of countries to be part of a trade bloc that excludes China. So I remember discussions with Mexico earlier had suggested that maybe Mexico could put the same tariffs on China that the U.S. puts on China, basically being part of the Team USA rather than Team China. And right now it seems like Vietnam has spoken with the U.S. and Vietnam is very close to China. And President Xi, it seems reporting suggesting that he's making a tour of Southeast Asia, trying to court countries there to be part of Team China. So it's possible that the world could be in the process of bifurcating. So again, a very interesting development in global trade. Now, one of the reasons why President Trump suggested that he might be pivoting is because of what he saw in the bond market, which brings us to our next topic. Now, inflation has been a concern for many people. We got the latest University of Michigan Consumer Inflation Expectation Survey, and it shows that inflation expectations, at least in the one-year time frame, are getting really, really out of control. For Democrats, inflation expectations are absolutely skyrocketing, very much a panic. Republicans don't seem to be phased so far. But I think the concerning thing is that independents are also becoming more concerned about not just short-term inflation, but also longer-term inflation as well. And their inflation expectations are rocketing far, far above the Fed's 2% target. So at least according to this survey, again, the University of Michigan survey is just one survey and there are flaws to it. There are more and more people concerned about inflation. Looking at market-based indicators of inflation, the 5-year, which is 5-year inflation 5 years from today, continues to suggest that the market is much more concerned about recession than inflation. Although, of course, it does expect inflation within the one-year time frame due to tariffs. However, the hard inflation data we got the past week was very benign. CPI month over month was actually negative. Core CPI was about 0.1. So again, on a month-over-month basis, very benign inflation print. PPI, which is inflation faced by companies, was also lower than expected. Now, taking all this information into account, the Cleveland Fed inflation nowcasting is suggesting a very, very benign core PCE and PC for the month of March. So the lower than expected inflation from our inflation data was largely driven by energy. Now, if you look at the price of crude oil, it's absolutely tanked in part due to recession fears. However, it's also declining in part due to increased OPEC production. Now, not widely noticed, but hours after Liberation Day, the OPEC also announced that they are increasing production, and so that's weighing on energy prices. Now, I think we should also remember that in January, President Trump gave a speech saying that his plan to get inflation down is to get oil prices down, and he would do that by encouraging Saudi Arabia, and OPEC to pump more, and in addition to deregulation and all that. And it seems like that's happening at the moment.
And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down.
So that should be helpful for inflation going forward. Notwithstanding that, the people are very panicked. And interestingly, the bond market, looking at the bond market, again, yields, 10-year yield rose pretty notably throughout the week, closing on Friday at around 4.5%. Now, as we've discussed, this isn't really inflation expectations. It's just seemingly a lot of people selling, which goes into our last topic, very strange price action the past week. Now, historically speaking, when we have these big risk-off events, we would expect two things. We would expect there to be a flight to treasuries, again, flight to safety, and we'd also expect the dollar to strengthen. Dollar has this relationship where when there's stress in the world, people run into the dollar, run into treasuries. But we didn't really see that the past week, actually at all. Now, tariffs had been very much a dollar strengthening move, and risk off usually is dollar strengthening as well. But as stocks sold off, as tariffs, again, continued to weigh on the market, we actually saw the dollar depreciate pretty significantly, especially against the euro. The dollar index, well, basically dropped a lot. At the same time, we would expect the treasuries to get a bid. The market would price in more Fed cuts, and that would lead to the treasury market rallying, so yields lower. However, treasuries sold off basically throughout the week. Even more interestingly, throughout this, the one safe haven in the world seemed to be gold. Gold rallied basically every day and honestly looks like it's going parabolic. So this suggests, well, there are a few stories that explain this behavior. One popular story is the blowup of the so-called basis trade. So basically, and Treasury Secretary Bessent also suggests this as well.
Very often in my market career, there's one of these deleveraging convulsions that's going on right now in the markets, and I think it's in the fixed income market. There's some very large leverage players who are experiencing losses. They're having to deleverage. I believe that there is nothing systemic about this. I think that it is an uncomfortable but normal deleveraging that's going on in the bond market.
There's a lot of leverage in the market, and as people deleverage, they're selling things like treasuries, and so you get all these weird relationships. A popular candidate for deleveraging is the basis trade. Now, people have been talking about this a lot. So what the basis trade is hedge funds, they sell treasury futures and buy cash treasuries and try to profit from the difference between the two. If they were to deleverage, as they did during March 2020, they'd have to sell cash treasuries, and so that can lead cash treasury yields to rise. Although I think people who are in the market don't really see evidence of this, it is a very prominent story. Another prominent story is that China, due to the trade war, is liquidating their treasury securities. Now, China holds a lot of treasuries. Exactly how much, it's a state secret, but people usually think it's at least $1 trillion worth. So that could be happening. We don't know. We'll know later on from the official data, or if it's done through proxies that are not in the official data, we may not know as clearly. So that's possible as well. Now, a third possibility, and this is what I will write about, which I think may actually be happening, is that we are in a fundamental regime shift where the dollar is becoming less prominent, U.S. less of a safe haven, and where foreigners are potentially exiting the U.S. assets and rebalancing a bit of their portfolio towards, foreign assets or maybe gold. Now, if this is the case, it could be potentially very disorderly. I know we get some reprieve in the markets, but I continue to think the lows of this cycle are not yet in. So it's whether or not which story is true, and maybe there's some truth to all of them, we'll definitely find that out in the coming weeks. But one thing I think is pretty sure is that there are big fundamental changes in the global economic order. And if you change trade relationships, you also necessarily change capital flows. And if you change capital flows, you're also going to change a lot of relationships we see usually in the market. So again, be on the lookout for that. All right, so that's all I prepared for today. Very exciting week. Next week is probably going to be just as exciting. All right, guys, be careful, and I'll talk to you all next week.